This video is created strictly for educational and informational purposes only. Nothing in this video is financial, investment, legal, or tax advice. What if you could own the entire future of technology with just one single investment? We are talking about the massive giants that power our world today. Apple, Microsoft, NVIDIA, Broadcom, Adobe, Salesforce. These are not just companies. They are the engines of the global economy in 2026. While millions of investors are out there trying to pick individual tech stocks and failing, the smartest money in 2026 is quietly flowing into the Vanguard Information Technology ETF, ticker symbol VGT. This ETF currently manages over $147 billion in assets. That number alone tells you that institutional investors and smart money already knows the secret. In the next 10 minutes we are going to do a complete deep dive into why VGT is currently one of the most searched and highly discussed ETFs in the entire United States. Whether you are a complete beginner looking for your first tech investment or an experienced investor looking to maximize your portfolio returns, this breakdown will reveal absolutely everything you need to know about owning the technology kings of the world in 2026. Stay with us because what you are about to learn could completely change how you think about building wealth through technology. So what exactly is VGT? The full name is the Vanguard Information Technology ETF. This fund tracks the MSCI US Investable Market Information Technology 25/50 Index. In simple terms, it is a basket of 324 different United States technology companies all bundled into one single easy-to-buy investment. But unlike broader market funds like VO or VTI, which hold companies from every industry, VGT is 100% purely focused on technology. This means every single dollar you put into VGT goes directly into American technology companies. No banks, no healthcare, no energy, just pure technology. VGT is managed by Vanguard, which is one of the most trusted and respected investment firms in the world. Vanguard was founded by investing legend John C. Bogle, who pioneered low-cost index investing. Launched back on January 26, 2004, VGT has now survived multiple market crashes, including the 2008 financial crisis and the 2020 COVID crash, and has come back stronger every single time. As of May 2026, VGT is trading at approximately $113 per share with an AUM of $147 billion. The fund has delivered a stunning 1-year return of 58% and a 5-year average annual return of 20.7%. These are not normal numbers. These are the numbers of a fund that is built to capture the most powerful secular trend of our lifetime, the technology revolution. Now let us talk about the holdings, because this is where VGT gets its real power. The top 10 holdings make up 59% of the entire fund, which shows how concentrated and powerful these companies are. The three biggest holdings are Apple at approximately 14%, Microsoft at approximately 11%, and NVIDIA at approximately 18%. Together, these three companies alone make up nearly 43% of the entire fund. But VGT goes far beyond just the big three. Let us look at all the major holdings beyond the top 10. In the semiconductor space, VGT holds NVIDIA, Broadcom, Texas Instruments, Applied Materials, Lam Research, KLA Corporation, Microchip Technology, Analog Devices, and Marvell Technology. In the software space, VGT holds Microsoft, Salesforce, Adobe, Intuit, ServiceNow, Workday, Palantir Technologies, Fortinet, CrowdStrike, and Palo Alto Networks. In the internet and e-commerce space, VGT holds Alphabet, which is Google, Meta Platforms, and Amazon Web Services exposure through its cloud division. In the hardware and devices space, VGT holds Apple, Dell Technologies, HP Inc., NetApp, and Western Digital. In the payment technology space, VGT holds Visa, MasterCard, Fiserv, Automatic Data Processing, and Paychex. By owning VGT, you are essentially making a bet on the continued dominance of American technology across every possible subsector, from artificial intelligence to cloud computing to digital payments to cybersecurity to semiconductors, all in one single low-cost investment. Let us now look at how VGT breaks down by technology subsector in May 2026. Semiconductors and semiconductor equipment make up approximately 34% of the fund. Software makes up approximately 28%. Technology, hardware, storage, and peripherals make up approximately 17%. IT services and consulting make up approximately 12%. Electronic equipment, instruments, and components make up approximately 5%. Communications equipment makes up approximately 4%. This diverse mix within the technology sector itself is what makes VGT so powerful. It is not just a bet on one part of technology. It is a bet on the entire information technology ecosystem of the United States of America. When AI drives demand for chips, the semiconductor companies in VGT win. When businesses move to the cloud, the software companies in VGT win. When digital payments grow, the fintech companies in VGT win. No matter which part of technology leads the charge in 2026 and beyond, VGT is positioned to capture those gains. Now let us talk about the performance numbers that have attracted over $147 billion into this fund. These are real verified numbers as of May 2026. The year-to-date return for VGT in 2026 is 19.5%. The one-year return is an incredible 58%. The 3-year average annual return is 33.3%. The 5-year average annual return is 20.7%. To put these numbers in perspective, the S&P 500 has averaged approximately 10% per year over the long term. VGT has been delivering double that and more. If you had invested $10,000 in VGT 5 years ago and reinvested all dividends, your investment would now be worth approximately $26,000 today in May 2026. And with the current AI super-cycle driving unprecedented demand for technology products and services, many analysts believe VGT is positioned for continued strong performance throughout the rest of 2026 and beyond. A question that every US investor asks when they discover VGT is this: should I buy VGT or QQQ? This is one of the biggest debates in the ETF investing world right now in 2026. Let us break it down clearly and honestly. QQQ tracks the NASDAQ 100 index, which includes the top 100 non-financial companies listed on the NASDAQ. It is incredibly popular with over $300 billion in assets. But here is the critical difference. QQQ is not a pure technology fund. QQQ includes non-technology companies like Costco, PepsiCo, Monster Beverage, Booking Holdings, and other consumer and retail companies. These companies reduce the pure technology exposure you get with QQQ. VGT, on the other hand, is 100% pure information technology. Every single holding in VGT is a technology company. This means when technology runs, VGT runs harder. When technology falls, VGT falls harder too. This is the classic trade-off between concentration and diversification. QQQ expense ratio is 0.20% while VGT charges only 0.10%, making VGT 50% cheaper to own. In 2026, we are seeing a growing trend of sophisticated investors choosing VGT specifically because they want maximum pure technology exposure without paying extra for non-tech holdings. If you believe deeply in the technology revolution of AI and want the most focused play, VGT is the superior instrument. One of the most compelling reasons why VGT has attracted $147 billion from investors worldwide is its extraordinary cost efficiency. The expense ratio of VGT is just 0.10%. That is $10 per year for every $10,000 you invest. Let that sink in. For $10 per year, Vanguard gives you access to a professionally managed portfolio of 324 of the most powerful technology companies in the United States of America. Compare this to actively managed technology funds that charge 1% or more per year, which equals $100 per year per $10,000. That is a 10 times difference in cost. Over a 20 or 30-year investment horizon, this difference in fees can literally translate to hundreds of thousands of extra dollars remaining in your pocket through the power of compound interest. This is the Vanguard philosophy. Keep costs as low as possible so investors can keep as much of their returns as possible. And this philosophy has clearly worked given the massive inflows and outstanding performance of VGT over its more than 20-year history. Many investors ask whether VGT pays any dividends. The answer is yes. VGT currently pays a dividend yield of approximately 0.35% annually in May 2026. The fund has paid $3.06 per share over the past year. Dividends are paid quarterly, which means investors receive 4 payments per year. Now, this is not a high-income ETF like JEP or SCHD. The dividend yield is low because technology companies generally reinvest their profits back into research and development and growth rather than paying large dividends. The real return on VGT comes from capital appreciation, which has been spectacular as we discussed. But the quarterly dividend is a nice bonus on top of the growth, and it can be reinvested automatically to buy more shares over time, which further accelerates the compounding effect of owning VGT for the long term. Now we must honestly address the risks of owning VGT because every investment has risks and it would be irresponsible not to discuss them. First and most importantly, VGT is heavily concentrated in its top 3 holdings. Apple, Microsoft, and NVIDIA alone make up approximately 43% of the entire fund. This means if any of these 3 mega-cap companies has a significant earnings miss or faces regulatory action or loses its competitive edge, the impact on VGT will be immediate and significant. Second, VGT has a beta of 1.23, which means it moves approximately 23% more than the broader market in both directions. In a bull market, this is fantastic. In a bear market, it can be painful. Third, technology stocks are particularly sensitive to interest rate changes in the United States. When the Federal Reserve raises interest rates, technology valuations tend to come under pressure because many tech companies are valued on future earnings, which are discounted at higher rates. You must be prepared to handle corrections of 20 to 30% without panicking and selling at the worst possible time. Tech investing is a long-term marathon. Historically, investors who held through every correction in VGT were massively rewarded. As we look ahead through the rest of 2026, the future outlook for VGT is dominated by one massive theme: artificial intelligence. We are currently in what many analysts are calling the AI super-cycle. The companies inside VGT are spending hundreds of billions of dollars on AI infrastructure, including data centers, high-performance computing chips, cloud platforms, and AI software applications. This investment is now beginning to generate real measurable revenue for these companies. Microsoft is monetizing AI through its Copilot products across Office and Azure. NVIDIA is generating record revenues from its AI chips. Salesforce and Adobe are embedding AI throughout their software platforms. Alphabet is integrating AI into Google Search and Google Cloud. Every major company inside VGT is either a direct beneficiary of AI or is actively building AI tools that other businesses are paying for. This creates a compounding tailwind where AI investment drives revenue growth, which drives stock appreciation, which drives VGT performance higher. For long-term investors, this represents one of the most significant wealth-building opportunities that the technology sector has ever produced. So, who exactly should consider investing in VGT in 2026? VGT may be an excellent choice for investors who have a long time horizon of 10 years or more and believe technology will continue to lead the global economy. It is great for investors who want maximum exposure to the US technology sector without picking individual stocks. It works well for investors who want to complement a broad market holding like VO or VTI with a sector-specific technology allocation. It may also suit investors who believe the AI revolution will create massive wealth over the coming decade. VGT is generally not the best choice for investors who need income from their investments since the dividend yield is very low. It is also not ideal for investors who cannot handle significant short-term volatility or who have a short investment horizon of less than 5 years. For most long-term growth-focused investors, however, VGT offers a compelling combination of low-cost professional management and exposure to the most powerful companies driving human progress in the 21st century. In conclusion, VGT is the ultimate way for investors to own the leaders of the digital revolution in 2026. It provides an ultra-low expense ratio of just 0.10%. It has delivered a stunning 58% return over the last 12 months. It manages $147 billion in assets from real institutional investors. It holds 324 of the most powerful technology companies in the United States, and it is positioned perfectly to capture the next wave of AI-driven growth across software, semiconductors, hardware, and digital services. Whether you are building a long-term retirement portfolio or seeking aggressive technology growth, VGT deserves a serious place in your investment conversation. Now we want to hear from you. Are you Team VGT or Team QQQ for pure technology exposure? Drop your answer in the comments below and tell us why. If you found this deep dive valuable, please hit the like button right now and subscribe to ETF Holdings USA. We are incredibly close to our goal of 1,000 subscribers, and every single subscription helps us continue to bring you the most detailed and data-driven ETF breakdowns anywhere on YouTube. New video every single day. See you in the next one. This video is for educational purposes only, not financial advice.